it's a program that is strictly based on income from the property you buy, how much rental income it creates compared to the monthly payment on that property.
Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
Okay, welcome back to the show this week. We're talking about a cool program that has been something we've been working on and doing for, a couple of years now, but it's really hitting the mainstream and gaining a lot of attention. And this is a DSCR, or investor cash flow loan. There's a bunch of different words for it, but DSCR basically stands for debt service coverage ratio. So it's a program that is strictly based on income from the property you buy, how much rental income it creates compared to the monthly payment on that property. So really cool program, simple qualifications as long as you have the down payment, but we're excited to go into details.
Yeah, so basically the program, we don't take into consideration your personal income. That does not matter, your debt to income ratio. It is strictly the property's income that it's going to produce, whether that is for short-term or long-term rental, which we'll talk about, it's pretty rare, versus the actual payment on that property.
Mm-hmm. And there are some significant differences, just to put a plug in for our program in particular, because there's programs like this with many lenders around the country. Ours is very unique for a few reasons. One, it is done in-house by Cross Country Mortgage. So this is not done by a third-party company where guidelines can constantly change. And our guidelines change sometimes, but we've never seen them get worse. They only get better. They expand qualifications, they get easier, so on and so forth. There are a lot of these types of programs that are offered as available, but oftentimes they're very challenging to get qualified for. So I think that's one thing. But then one example of that, which we're going to dive into how you calculate this, but we can go as low as a 0.75% or a 0.75 debt service coverage ratio, which that's a big deal. Lots of companies are over 1 as a mandatory requirement on any type. And like TJ said, lots of companies don't allow you to use nightly rental income to qualify. So,
so you were talking about the ratio. What is the ratio on a DSCR loan?
So I recently was explaining this to a client this week. And so I figured I would just pull up the explanation I gave them. So basically it is the rent, the gross rent you collect divided by the mortgage payment equals a number. That number is the DSCR, the debt service coverage ratio. So an example is, say you had $5,000 in gross rents and you had a mortgage payment of $4,500. 5,000 divided by 4,500 equals 1.11 DSCR. So like I said, the minimum on our program, on the standard program, is 0.75. So that property easily qualifies. Now on the option that allows nightly rental, the minimum is 1.0. So you got to be cautious. There are some differences here, but just another real quick example, because on the nightly rental version, this is the newest addition to this program, is the nightly rental, and it's really powerful. Our company uses strictly AirDNA data to qualify you. And AirDNA, it's a very reputable source. Lots of people that are in this market use it as their tool or one of their tools for underwriting if they're going to buy one of these properties. And we use it for underwriting the mortgage. So it's kind of nice that way. But
do you know of any other programs or companies that allow you to use nightly rental income?
I personally don't.
This is the first time I'd heard of it. When you rolled this out last week.
Yeah, 100%. And it is powerful. So it lists on AirDNA there's certain metrics that you have to qualify for. So call us for details. There's scoring on AirDNA that you have to hit a certain score in order to use this income.
The property also has to be in an Airbnb approved area.
Right. So you can't just choose some random property that it's restricted and hope that you can get this program. But another example, say AirDNA reported gross annual income expectations of 150,000. Now it's rarely, I've never seen it be an exact figure. It's always some very specific number, but for sake of this calculation, 150,000 in annual income from AirDNA. On the nightly rental option with the AirDNA or Airbnb VRBO type setup, you have to take a 20% expense factor out of the rent. So basically, you take 150 grand times that by 80% is 120,000. Divide that by 12 equals 10,000 per month. As long as your mortgage payment is less than 10,000 per month on that property, you qualify using the nightly rental. So this is huge because you can buy luxury properties. We can finance, I think, up to $2 or $2.5 million.
Yeah.
You'd have to call us to be sure. Yeah, $2 million. Let's just be safe there. But you can buy luxury property or finance, up to $2 million. You can buy a luxury property with a very large mortgage payment, knowing you can get this big revenue, because there are certain properties in many areas, even here in Utah, that you can get massive revenue and qualify without any personal income. So think of like W-2 people that wouldn't qualify, or more importantly, self-employed people, or especially real estate investors in particular. Many of them have no documentable income because it's all rental income and it gets quirky. And so
that's what I was going to lead into is, okay, who is this loan really for?
Yeah.
Because I was talking to someone about this last week and like, why wouldn't I just do a regular investment loan versus a DSCR loan? Well, if you're someone that maybe doesn't claim a lot of income, maybe you're self-employed and you write a lot off and you wouldn't qualify otherwise, this would be a great program. And another person also said, well, this sounds pretty risky for the bank. What's the catch? There's no catch. The thing is, you need to put down a little bit more money. Honestly, though, not much more than you can even be the same on a normal investment loan anyways.
It's basically the same. Well, 20%, I think, with the regular
20%
DSCR loan.
But AirDNA is going to be 25%.
Yeah, so an Airbnb property is 25% minimum. So it's like,
It's,
I mean, that's what even though you can do less on a regular investment property, I normally guide my clients to put 20 or 25% down anyway.
Exactly. And pricing isn't all that different. It's crazy how
it's
similar
pretty
it is.
competitive. Well, and one thing, sorry, we keep differentiating between regular and Airbnb. Now, we're very excited about the nightly rental one because it's the new thing. Regular, the way you would calculate that, the rent, is you would get an appraisal. From an appraiser would go out and give us the value of the home. You buy in the house at $600,000. Is it worth $600,000? But additionally, they would provide what's called a 1007. And the 1007 is a rent comparable. So they would go find rental properties nearby the property you're buying and assess how much are they collecting in rent. And then they would give us an appraiser's estimate or determination on what the monthly rent should be. And that's what we use on a non-nightly rental version. On the nightly rental version, like we said, we use AirDNA to justify what the rent costs.
Yeah, and I heard from an appraiser earlier this week as well on this, and they also, if the property is already being rented out before, if you can get a copy of that lease agreement and give it to the appraiser, they will take that into consideration when they're doing their 1007.
That's really good. One important thing that you bring that up. Now, this is pretty unlikely to be a problem on the nightly rental version of this program. And it makes a lot of sense, but the property must be vacant when you acquire it.
Yes.
And that program is only eligible for purchases, not refinance. The reason for both of these things is if it's occupied, clearly it's not a nightly rental property. There's a tenant in there, a long-term tenant. So that has to be vetted out. But then number two, the reason that program in particular is only eligible for purchases is because if you've owned the property and you've claimed this nightly rental income, you have it on taxes. When you have taxes, we no longer need to use a program like this. We can just use regular Fannie Mae or Freddie Mac, just regular programs because you have the income documented. So this is for the acquisition, allowing you to buy these properties without having to hit you for the whole payment. Because prior to this program, you wanted to buy a nightly rental, you had a couple of options. One, if you could qualify with the very small 1007 rent that we just explained, the estimated long-term rent for this property, that would work. Or if you could qualify for the whole payment, of course, that would work. But normally what I find on these nightly rental ones is if you looked at a long-term rental, you'd be renting a property for $3,000 a month, and that would be your revenue. But you look at that same property because it's eligible, it's in the right area as short-term, you're making $12,000 a month or something crazy. So very significant difference and makes it way more accessible.
Yeah, no, I'm glad you stated that. Also, if say you already own one and you're trying to tap into equity, it might be difficult to do so with a DSCR loan. The only way you can use that equity is if you're paying off business debts. It can't go towards your personal liabilities.
Yeah, because it's like a business purpose loan. They're looking at you as an investor.
Right.
So it's like there are some lines drawn there. But the cool thing is, like I mentioned before, the program's very, very, very flexible. It's all done in-house. The capital is cross-country mortgages capital. So there's not a third-party there is third-party underwriting. Let's say that. There's cross-country capital's underwriting team that does this, but there's not we don't have to broker this out to another company that's unaffiliated with us.
We've got direct access and contact to them
Exactly.
if we have questions.
Yep, for sure. And exceptions. Like if you don't hit the guidelines exactly on our programs, and this is just one of many programs that apply. Like we have, bank statement loans. We have
pretty much any program under the sun besides a strict land acquisition loan.
Yeah, exactly. Basically, if you don't qualify for a regular mortgage, like a Fannie Mae or conventional or Freddie Mac, those are conventional, or FHA or VA or anything like that, because of some reason, whether it's income related, it's maybe a credit event like a bankruptcy, short sale, something random like that. Maybe it's the type of income you earn. It's just quirky and doesn't quite meet regular what's called agency guidelines or conventional or FHA or VA guidelines, USDA, so on and so forth. We have a program that will apply. That's what this DSCR program, that's kind of the umbrella it's under, and we have so many. But the cool thing is it's all in-house, direct access. We can get tons of exceptions. That's where I was going with this. I lost my train of thought, but we can get exceptions for, I've never had one declined.
No, I haven't either. Or if they don't fit in this box, we have underwriters on staff that are basically, hey, it doesn't fit in this box. However, it fits in this box. Let's go this way.
Yep.
So the team is here to help.
Yeah, I think that's maybe the most important thing, which us as industry pros, we recognize this just intuitively because if you're brokering a loan, they aren't quite as motivated to be sure the deal gets done and you perform. Here we are because it's our brand, it's our success, it's our reputation, and we're all at the same company, right? So we share in the success of our branch. Corporate shares in the success of our branch, and these underwriters share in the success of our branch and all the branches around the country. So having that kind of just let's get a deal to work mentality is really important, and they're flexible because of that, which is rare. You do not find that honestly, a lot of these types of options have dried up in the market, and we've just dramatically expanded ours over the past couple of years, which is cool.
Yeah. So if the DSCR loan sounds like something you're interested, or you know someone that might be interested in this, reach out to us. We'd love to help out in any ways. But if questions come up, let us know, and we'll catch you on the next one. Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.